Good afternoon, everyone. Doing this video market recap for those who have asked for it on the morning note. So here we are. Let's recap the week. Thank you so much for joining me. This is Carlos Garcia, founder and CEO of GAR Capital. Thanks for taking the time out of your day to join me today and every morning at 9 a.m. And maybe we'll do more of this at right after the bell, 4:05, 4:07 p.m. Either way. Hope everyone's having a nice Friday evening. Let's go ahead and talk about it rather quickly, since there really isn't much to discuss, but still, let's go over it. Round the horn, afternoon style. Dow Jones, not futures, down 127 points today. Nasdaq gave back some of the gains that we had from yesterday, obviously, down 1.5%. S&P down 1%. The VIX, interesting enough, volatility index was down 1.76%. Equal weight S&P down 1.23%. Small caps IWM dipped better than the rest of the majors, down about 0.68%. The dollar was the big news today. We're going to go and chart it together. That was up 1.19%. Interesting enough, of course, that we talked about this correlation before. The inverse correlation, when the dollar goes up, stocks go down. That's what's been happening. Let's go to the 10-year Treasury yield. They went a little higher, 3.532% today. TLT, which is the 20-year bond fund, down 1.45% today. High yield credit was down 1.06%, and investment grade down 1.15%. So interest rates climbed today as there was a bond sell-off as well as an equity sell-off. That's where we are today. The S&P ended the week green. I believe I just tweeted about it. Let's go ahead and go over the numbers. Here you go. All right, here's the S&P from our Twitter. And 5-day performance this past week was up 1.62%. Pretty good, even though we had a Fed week. We also had a lot of corporate earnings. Some corporate earnings did not do very well, and some didn't do as great, but still went higher anyways. That's Apple. 1 month so far, we're up about 6.2% on the S&P. The last 3 months, up about 9.7%. Year to date on the S&P is up 7.73%. So we need to see if this new bull market, according to the QQQ, since we got above 20% from the lows, is about 7.73% right now in the S&P. Do we have a little more room to go? I say we do. QQQ being in a bull market, again, 20% off the lows is a new bull market. As of yesterday, we pulled back, obviously. Just want to go ahead and reiterate that. I really didn't want to chop that up. 1 year relative, 52 weeks, the S&P is still down 8.09%. Just last year, we were in a bear market at the lows. I think the worst we were was right around 22, maybe 23% drawdown on the S&P 500. In regards to news today, we also got the non-farm payroll report as well. We talked about that this morning. So knowing all that, we had the big rise yesterday. We're going to go ahead and chart quickly to the S&P 500 futures. Let's go to the daily. And again, that 4,200 being a very, very key level. We broke above that. Again, that could be a resistance moving forward. Totally understandable. I got 42.44 as my next resistance. That's your 786 Fibonacci level. If you're talking about where we can pull back, where's your next support, you do have a trend line that's actually been holding up rather well since the 23rd of January. Pretty small sample size, but still a trend line nonetheless. 4,100 being a key support there. As we see, we did have a red candle today, obviously from the big rise that we had the past 2 days. Some give back or get back, if anything. So in my opinion, still, this is a buy the dip market until you start breaking below 4,000. Now you're probably saying 4,100, that would not be a good level. Well, again, if we actually break below that, that doesn't mean we're going to get straight to 4,000 either. Again, we actually wicked below that trend line back on the 31st of January, and yet we ended the day rather green. So again, be more elastic with your stops. Again, it's good to have your stops, obviously, but understand when you have your trend lines, resistance and support act as more of a mattress sinking in than it rather is a hard board where you just can't break, or if it breaks, it's broken. No, it could be sinking in a little bit softly and still bounce, or break up a little bit and still come back down. Again, you have to be at least a little more cognizant of that when you do your technical analysis. So 41.44 is where we're at currently. We're still above moving averages. We still have a golden cross, so that hasn't changed. Let's go to the NASDAQ futures. NASDAQ futures, again, we talked about this on Twitter, that rejection of right around 12,900, 12,894. For the time being, that will be our resistance moving forward, being a key level. We did reject that. We're down now to 12,615. No real meaningful gaps to the downside that I see. So again, maybe you'll get to around 12,511 as support. That would be a retest or a recheck back of the yesterday's big move. And again, that would be acting as your support, at least currently. You're still, quite a bit above the 200 moving average as well. We've settled above there and settled above the trend line. So I've seen a lot of charts out there on Twitter where people are saying, oh, we broke out this above the trend line as well, and we did fall, and that was a bear market rally. But we were not sustained above the 200-day moving average. In my opinion, that's what's really setting the tone. Again, in terms of momentum in the stock market, it's more important to understand that don't fight the flow versus don't fight the Fed. Stock market right now, at least since October, is the hot commodity, is the one that everyone wants to get into. Again, people thought, I guess, on October 11th, being the bottom, individuals, funds, all of a sudden saw stocks too good to pass up, or you needed to buy some. Now, again, that's not the case for every single stock. Obviously, you do have short covering, but again, we can see the momentum moving higher with that golden cross, all moving averages moving higher, and a macro backdrop that's actually sustainable and holding up. Keep in mind, guys, we are still 350 basis points away from where we started in the tightening cycle, yet we're starting to bounce a little higher. Now, again, do we break the August highs? We have to wait and see. But at least moving forward, at least we understand now, even with the Fed tightening rates, this labor market is still strong. Now, again, you can be in the camp of that the Fed has to tighten even more, which is completely fine. Or you're in the camp that the market doesn't care what the Fed does. It's all about resiliency of the market, and it really is all about momentum. I'm more of the latter than I am the former currently. In terms of the week this week, guys, we did pretty good. We caught Apple for Masterclass, so well done, team. Let's go ahead and chart it rather quickly. Let's see here. We'll go to Apple. And basically, we had the pullback like we talked about in the morning note. I caught it for next week. The 155s, well done. It was in the money. I think it got as high as around 318%, so well done, team. It was a quick one. Some of the individuals in the Masterclass did not catch the exact print that I got, but again, well traded nonetheless. The only big L for the week was the QQQ puts, and that sucks because our target was 280. Well, 285 puts was our strike. That was this week. We actually hit that target at 6 a.m. and 7 a.m. on that morning, and we soared. And oh well, insurance sometimes does not pay off, but that was our week. We also hit Google calls. Well done, Nick. Tesla calls. That was a well done effort by the team. And NVIDIA calls were done yesterday by me and Anthony. So well done to the team. All of us coming together and just trying to get a hit it. Sometimes you just got to hit that momentum. Whatever the stock is moving, we're in to trade it. That's it. As long as there's volume there, we can get a good price. We're all about it. And obviously, if the macro and the actual charts line up. Real quick on the dollar, then I'll answer some questions here, guys. Let's see. We'll go to the weekly. And again, a bounce right here, right around 101.2. If we're looking at a possible resistance, again, if we continue to go higher, it's right around 105.02. That will be your 50 weekly MA on a bigger time frame. If we're on a daily basis, a daily chart, 103.82. I think I'm going to go and place an alert there. If that does break, you're going to see more weakness in the S&P 500. But I want to have this point really sent to you guys. Let me go and see. Here is the chart that I want to show you guys. I have to scroll down my Twitter, which is always fun. Okay, here we go. So this is the seasonality for the S&P 500 in a pre-election year being 2024. And as you can see, January, rather strong. So far, so good for February. Expect to have a dip in the middle of the month. I don't want you guys to be surprised. You're not going to go straight to 5,000. Get that out of your head. That's not happening. You're going to get some pullbacks, completely fine. But what you want is a structured bull market with good support levels and momentum higher. I don't want a short squeeze GME spike. I don't want a meme craze mania spike. That's not sustainable, as we saw in 2021. So now we want to do things right with rates where they are. Again, maybe we pause, maybe we don't, but at least where we are in terms of rates, savers are definitely benefiting, which is a good sign. And yet equities are starting to bounce back. Even treasury yields are coming down as well. But yet the Fed funds rate is where it is. So again, expect a dip in mid-February and towards the tail end of February. March will have a dip as well. Again, all things being considered, this actually is the exact analog. But again, we'll go ahead and take it for what it is. Maybe we do expect a pullback. How does a pullback on the S&P 500 sound like? The dollar reaching about 105 or 106.36. That would be the script for the S&P to go lower. If we go ahead and start taking a look, that would probably get you to a right around, let's go to the daily chart on the S&P on the pullback, which is expected, and that's okay. Those are opportunities, at least in my perspective. We'd break 4,100, probably get you to a right around 40.24, which is your 20 moving average. I think that would probably be the worst of it if we get that seasonality pullback, if we get the dollar going a little higher. Again, just be on the lookout for that. One more thing before I finish up. I'm sorry, guys, for the questions. I'll make sure to answer your guys' questions. Excuse me. Monday, nothing going on. Tuesday, we have Fed Chair Powell speaking at the moderated discussion at the Economic Club of Washington. I don't know if he's going to talk about monetary policy there, but we'll keep an eye. That's at 12 p.m. Eastern time on Tuesday. Now we're starting to get Fed speak. Now everyone's going to have their opinion on the Fed. We know that. The Fed blackout period is done. So again, expect volatility right as we get to mid-month. When is mid-month? Next week. And what's next week? Oh, you guessed it. That is CPI. Perfect. So again, going up to CPI, I expect us to move higher next week. CPI will probably be a little hotter than expected due to a labor market. If we are at exact expectations for CPI, I'd be very surprised. If we are lower on CPI, I'd be extremely surprised. I think we'll be just a tick higher on CPI. Do not be surprised if inflation rears its ugly head ever so slightly as we get into the new year and asset prices are going higher. The only thing that's good here is that we're getting deflationary moves from commodities, but they also have bounced with the equity markets. It's kind of like this. So again, keep that in the back of your head. Mid-month swoon, a little bit of a dip, CPI on the 14th, right on Valentine's Day. I'm not saying sell everything tomorrow. No, just be ready and be cautious. That's it. All right, let's answer some questions. What a great week, man. Well done. Great week. Can you explain how does the positive payroll news affect the markets today? There's a great movie that I recommend people watch at least the clip, The 25th Hour, where there's a day trader. He's talking about the unemployment report. It's a great clip. Just Google The 25th Hour YouTube trading scene, and you're done. I'm going to explain it. When you have more people working, that still creates more demand. Regardless of what anyone says, if you are employed and making a constant paycheck, you're going to spend money. If you don't have a job, more than likely, you're going to be more of hoarding of money. The problem is that as labor pressures rise, wages go higher. The good news is that today's payroll report did not show wages go above expectations. Only the jobs number did. The other side of the coin is that many people are looking at the Fed as saying, wait a minute, did you not see the payroll number right now? Are you still going to be monitoring? Are we still going to do 25 basis points? I think the expectation now with this actual payroll print, but we're still missing the next piece, which is CPI. If we have a CPI that is at expectations, not lower than expectations, I think we'll get a 25 basis point hike in March. If the CPI comes in better than expected by a wide amount, the way the non-farm payroll report does, then I would expect a pause. But again, that's a lot of assumptions moving forward. So again, let's go with it a day at a time, a session at a time. But in terms of the jobs number, more people employed means more people spending. And what the Fed is trying to do is kill demand since they have no way to control supply of goods and services. They can't do anything. They don't create anything. They don't build anything. They don't hire anybody. The Fed only changes one thing and one thing alone, the Fed funds rate. That's it. So that's their primary lever in terms of fighting inflation. Obviously, they could do quantitative easing, quantitative tightening, all that jazz. But again, a higher employment environment That means more money is more plentiful for workers, meaning they're going to spend on goods and services. Inflation tends to go higher. So again, that's where this CPI number coming in is going to be extremely important. Do not be surprised you get a dip in mid-February. Just like I said, just like we're showing here on the seasonality, showing it right there. And again, this is a stretched out period since 1950 to now. This is how it's been in terms of the moves each and every month in a pre-election year. Does it have to be exactly the same? No. But again, it's something to keep an eye on. The NASDAQ and S&P had 20% moves off the lows during the 2000 to 2002 bear market before dropping to new lows. That is correct. And we also had a dot-com boom. And something else happened that was kind of a big deal. It was 9/11. Now again, unless we're expecting another terrorist attack or even more pain in terms of the dot-com bubble or these high beta names, which I don't see it at least in the credit markets. If high yield credit was actually tanking, I'd be more on that side as well. But again, it's not an apples to apples comparison. In terms of charts, could be. But again, people were saying last year, we were in the 2008 analog where October was going to be that next leg lower. People tend to forget that in 2008, that's when Lehman Brothers filed for bankruptcy. That's kind of like a big moment, a black swan moment. Our black swan moment in 2022 was really the Putin invasion of Ukraine. Other than that, I don't think the FTX collapse was a big deal. The Almeida, whatever it's called, Bitcoin didn't really suffer. It actually bounced. So I think we just need to be sure that we have the correct comparisons. We want to have the right comps moving forward to understand that maybe not everything is equal. Some things can be fine, but I don't buy that premise that we're in that 2000 to 2002 kind of analog personally. What about BABA? BABA kills me. And again, we fell. And I own this stock, obviously, and it kills me that we didn't get that trade for Masterclass, which really sucks. But 116.61 does have a gap to fill the upside. Now you have a gap to fill to the downside. So you're pretty much right in the middle of it. And what can you do here? Nothing. I would not trade this name, at least moving forward. At least I can see some direction. If we bounce or if we fall, we'll see where we go from there. But not the best of trades, but hopefully Apple made up for that one. At least it made it up for me. How do I sign up for classes on options? Okay, so where you want to go, Mark, is to this website, gar.capital. No .com, just gar.capital. And there's the website there. Ask for some information, and my back office team will go ahead and answer your questions and get you taken care of. I think you might have covered IWM already, but can you give me some thoughts? Yes, I did open the IWM calls today. Let's go and take a look at it. So IWM, I sent this today. We'll go to the daily, and really I'm just looking at here. This is my target, $200.44. We also have a 203.62 level. No gaps to fill to the downside at least. Looking at 193.98 as support. Not terrible in terms of risk reward. Still holding up relatively well, performed better than the major indices. And if we go to the daily, let's see if we have any moving averages we can look at. How about the weekly? Yep. The weekly has the 100 MA on the weekly right at 202.94. Let's go to IWM calls, and you can see we do have about 7,000 involved in those 200s. But on the opposite side, we also have some high volume on the put side. So at least there is some demand for these contracts, which is something that obviously I'm looking for as a trader. So we'll take a look moving forward on IWM. I think it's still a great trade, and I'm glad I'm in it. NVIDIA, we hit this yesterday. NVIDIA pulled back, obviously, with the market. Let's go to the daily and see if anything has broken. Nope. But I think right here, this trend line right there, you can see that. Now that's your new support. That's probably the level you're going to look for to buy this dip. Again, if you wanted to go long, is right here. That's where you're looking for, that mid-February fall. And again, just based on the seasonality, we also have CPI that week. Why not? Why not? Does it mean to go into puts next week? I wouldn't. I would start looking at some puts ahead of CPI. I think we go a little higher on the S&P. That'll give us an opportunity to hedge to the downside ahead of an inflation number that may be a little hot because of this jobs number. So again, looking at NVIDIA Farina, you're looking at the 200 level as support. And in terms of short-term moves, again, you're at 196 right here. That's that trend line that we had. Really not a lot of edge here. You're probably going to tap this 50 MA right here at 207.46. Kind of lines up with last week's resistance. If we can check back there and bounce, then maybe give us an opportunity to go long as well. So we got both sides there. We'll keep an eye on it eye on it as we go. Wow, what a day. If you guys still want the newsletter this week, I'll be more than happy to do it. Just comment, please, newsletter. I do that every Saturday and send it out to you guys as well. But hopefully this video kind of covered everything. So any questions, feel free to type into the chat box and also in the comments section. I do read the comments. I don't know if that's a good thing or a bad thing. So who knows what nice things people would say about me, but that's the internet for you. We'll go and leave it there, guys. Have a great rest of your weekend, and we will see you guys on Monday. One more. Our Amazon and Google good trades for next week. As of right now, I would not touch it currently. We broke the 100 moving average on the hourly. In terms of the daily, let's see it. Daily might be hitting some support too, which is that 100 moving average right at 111. So I would not do anything yet on Amazon. There's no upside gap to fill. And in terms of Google, you do also have a downside gap at 102.29. I'm going to wait for that level, see if we can go ahead and go long. Maybe we get a gap down on Monday, gives us an opportunity to take a look at some calls. And if not, we get a gap up, I can take IWM for the money too. So works for everybody, hopefully. We'll leave it there again. Have a great rest of your weekend, and I will see you guys on Monday. Cheers, guys.